Good evening. Let's get started. Okay, tonight we will get through a few of those topics up there: general anti-avoidance rule, and form versus substance, transfer pricing. The general anti-avoidance rule, or form versus substance, as a general topic, is something that you must have seen, at least to some extent, in your study regarding U.S. taxation, because form versus substance is sort of a thing that we hold close to our hearts in the United States. Some places, perhaps, it's form over substance. The point is, we cannot assume that things are the same around the world as they are here. But also, because this whole area is one that is rather subjective, when I thought about how do we try to get across something that's actually useful to you, I gave, let's say, a reasonable amount of thought to how should this area be taught. And my thought at the end was to try to develop a framework for analyzing this kind of issue. Whether you're thinking about the U.S., whether you're thinking about another country, a framework I'm hoping will be useful to you in actually attacking situations and trying to, in a meaningful manner, resolve problem areas. And then the last thing, which is, I think, awfully important, and which hopefully we'll get across a little bit here, is that you have to develop, as part of your professional assets, so to speak, a sensitivity to when there's a problem, or where there might be a problem down the road with planning or structuring that either you're thinking about or that you see in place at your client or within the company that you're working for. First thing that I think would be useful is to say, what's a typical situation that a substance versus form or anti-avoidance rule is supposed to deal with? So just to give a simple example of this kind of thing in the international context, I thought would be useful. So with that in mind, take a look at this slide, which gives you some background on a situation, and then we'll talk about it. We're starting off with a situation that company A or individual A, whatever he happens to be, I don't remember what it said, is the owner of 49% of a Chinese company. And you also saw that if A sells this whole 49%, China will tax the gain. We saw the particular provision in the China-Hong Kong tax arrangement, which said that China will not be able to tax the gain if the sale is of less than 25%. And also, I believe, for a one-year period, A has not owned the Chinese company, or let's say 25% or more of the Chinese company for 12 months. So right now, if A were to sell to some third party, China would tax the gain, and the tax rate happens to be a 10% rate on the gain. So this is what's at issue. And in Hong Kong, since there is no tax on capital gains, and therefore no value to a foreign tax credit, Hong Kong doesn't have, to my knowledge, a foreign tax credit system at all because they're a territorial-based taxation country, in addition to not taxing capital gains. So this is non-taxable in Hong Kong in a sense on two counts. Number one, not sourced in Hong Kong, and number two, not being a revenue gain, but rather being, let's say, a capital gain. So not taxable in Hong Kong, and therefore, to the extent we can reduce tax in China, that's a full benefit. What A does is sell to, let's say, company B, which is, let's say, a subsidiary, of A, sells 24.5%, so that B now owns 24.5%, and A, after the sale, owns 24.5%. Now, is that first sale from A to B, is that a taxable transaction as far as China is concerned? You saw again, the treaty, which says that gain derived by a Hong Kong resident from alienation of shares in China may be taxed by China if within 12 months prior to the alienation, the receipt of the gains owned at any time not less than 25% of the entire shareholding. Okay, so China can tax this first gain. Let's say that, as the facts indicated, that at a future date, more than 12 months later, both A and B find some other buyer, and each one sells its 24.5% to this new buyer, and this buyer, of course, ends up with 49, and this 25, or this 24.5, and this 24.5 is gone, and all of it's owned by X, which is an unrelated buyer that bought at an arm's length price. Does each sale meet the test of that exemption that we saw in the treaty, or in the arrangement between Hong Kong and China?
You say it was over more than 12 months out?
Yes, more than 12 months out. Okay, so it meets the test. Now, this is the kind of transaction, or let's say this is a type of transaction which an anti-avoidance rule might be concerned about. A consciously transfers a certain amount of shares to B so that a later sale that maybe A plans to sell at some point in the future. So A positions itself so that legally the test of the treaty is met. Economically, A owns B. Ultimately, A is getting the benefit of whatever that 49% sales price is. But by positioning itself, technically, the terms of the treaty are met. So we have done something clearly in accordance with the law. Now, a substance versus form or some sort of general anti-avoidance rule will look at this and try to say, should this form be respected or should it not be respected? We'll talk a bit more about this example that we just had in a few minutes, but just to give a little bit more background on what a general anti-avoidance rule is. We find general anti-avoidance rules sometimes actually included in the law in statutory form. and sometimes we only find them through, let's say, judicial concepts. Now, I put down the U.S. as being a judicial concept one. Are there any anti-avoidance rules in the U.S. law? There are some that are focused at specific things. I must admit it's been years and years since I've looked at it, but I seem to remember Section 269 dealing with acquisitions is, let's say, an anti-avoidance rule, but again, it's relatively narrow in scope, and it's not something you see very often. So, in contrast to what I call a general anti-avoidance rule, the U.S. really doesn't have it, except through the judicial concept of substance versus form, and the large history of court cases that looks at this kind of thing. In China, we find a very short and sweet item in the enterprise income tax law, which was effective in 2008. If an enterprise engages in a business arrangement without bona fide commercial purposes that results in reducing its taxable revenues or taxable income, the tax bureau has the right to make adjustments based on reasonable methods. Does that sound broad? It's very, very broad. And as a result, pretty much anything that a taxpayer might do, whether a non-Chinese company or a Chinese company, where Chinese tax law is relevant, possibly to the transaction, this is a concern. Now, interestingly, in some countries, Australia, I guess Canada to some extent, where there have been very broad anti-avoidance rules, the courts have to some extent struck them down, and they've had to be redrafted to try to pass muster with the court systems in the various countries. Because this kind of very broad rule, as you might imagine, gives a lot of discretion to your friendly tax official. Getting back to China for a moment, there are some, let's say, more detailed rules that have come out, in this case in January 2009, which tried to give a little bit more guidance as to what are some of the areas that we think might be relevant to beat on taxpayers about. And notice the second one, abusive use of tax treaties. Well, we know that treaty shopping, so to speak, use of intermediary countries with beneficial tax treaties is an important part of international tax planning. So now, when we look at investing in China, and I suspect that some number of you are choosing China as a country for the case study, looking at Hong Kong as a location for an intermediary company in order to, for example, reduce your withholding tax from the statutory 10% in China down to 5% under the tax arrangement, that's something that you might want to talk about in your case. And then when we look at this point of being a specific focus of the tax authorities, will such a Hong Kong company in fact achieve the benefits? And what you might, of course, also think about is, are there things that ABC could do, assuming they choose to put a Hong Kong company in there? Are there things that ABC could do to strengthen the argument that, hey, we have a real company in Hong Kong that's doing things, not merely paper. So this kind of thing would be certainly appropriate to think about in connection with your case study. Singapore also has a statutory general anti-avoidance rule, which is a little bit longer in terms of words, but pretty much equally as broad. Notice how broadly they try to define arrangement. Any scheme, trust, grant, covenant, agreement, disposition, transaction includes all steps by which it is carried into effect. These provisions are generally written to be as broad as possible. In countries where the judiciary, let's say, has a bias toward officials, whether you're talking about China or perhaps Singapore as well, this the broad discretionary nature of this thing is not necessarily going to be knocked down by the courts, as it might be in a place like Australia or Canada, which has a strong tradition of judiciary independence. When countries look at the form of a transaction, they really look at the persons and the contractual obligations, the contracts that are in place, the entities that are in place. They're looking to see physically who's involved and what is involved. Assets, people, contracts, and so on. If we look back at our sale by the Hong Kong company, for example, the form really is, number one, a real sale by A to B. It is a real transaction which has enforceable terms. There's a real sales document. There's an actual change in the registered owner of the company. That will be reflected by a re-registration in China of the owners of that Chinese company. As I'm assuming this is not a publicly held company, but rather a privately owned company, so that there's a registration procedure that has to be accomplished when a new owner comes in. So there's a legal form which A and B and the Chinese company actually put into effect to reflect this change in ownership. Something legally happens. Something that is enforceable by courts and recognized by the relevant governments involved. Later, when A and B each sell to the third party, again, those are real transactions. The same documents are there, the same action to re-register the Chinese company, the ownership of it. So the form is there and it's real. Now later we're going to talk about sham versus real. But for the moment, these are real transactions. Whether they have any economic reality or not is a separate issue. But right now, they are real transactions. Now, if we look at substance, now we're looking not necessarily at the legal things that have happened, but we're looking more at issues of economic interest. In other words, a transaction has occurred. Has there been any change in the real economic interests of the parties. Control. Has there been any difference in the control exercised by the various parties over what they had control over before the transaction? And business activity. Has there been a change in the actual activity, irrespective of before and after the transaction? And again, looking back at our Hong Kong company example, we see that the sale from A to B, because A owns B, economically there's no change. A ultimately will benefit on whatever the selling price is down the road when they sell to X. From a control standpoint, A initially owned 49%, and then after the first transaction where he sold 24.5% to B, A held directly 24.5%, but indirectly he still controlled another 24.5%, so that in the great scheme of things, A really still has control over 49%. And business activity, at least in this example, isn't really part of the situation. I mentioned before that for the actual transactions that occurred, those were real. Because there really was a transfer of shares. There really was an agreement between two separate legal entities. There really was a purchase price for those shares that was paid by the parties. There really was a re-registration of the ownership of the Chinese company to reflect A and B as each 24.5% owners. That's a real transaction. The two parties between them are in fact conducting themselves as if those are real transactions between unrelated parties. Now, I'm ignoring the discussion at this point of transfer price, but the point is the terms of the agreements are being respected by both parties. The other one, sham or fake transactions, I'm defining these in a manner which might be a little bit different than we tend to use this term sham in the United States. In the United States, we tend to use the term sham as a label anytime there's a substance versus form issue where the substance overrides the form. And I don't like that approach just simply because it mixes things up. It blurs your ability to look at and try to analyze things and develop a framework that will be useful for you. So I want to define sham as really a fake transaction. I'm going to, let's say that Jasmine and I are going to enter into a contract where I sell her this. Now, I don't own this, it's not mine, but we enter into a contract and she pays me, let's say, some amount of money. Maybe I give it to her, or maybe I just put it back in the drawer, but we have an agreement that might be a form for her to pass me some amount of money, perhaps a bribe regarding the grade in this course, but still, we have a form which allows a payment to me, but she's really not expecting to get anything in return. You know, I'm just going to put this back in the drawer there and not going to deliver anything to her. Now, we have a contract, but is it something that we are both respecting? And the answer is no. It's really a fake contract meant to be window dressing for some other purpose that we have in mind. Now, I think in the couple of examples there that are mentioned, I think are reasonably typical examples of this kind of issue. If we have X, which let's say owns Y, let's assume 100%, and let's assume country A, country B, and let's assume that B is a high tax country, and as a result, X would like, as much as possible, to create payments from Y to X that allow a deduction against the income that Y is earning, so that we both get a tax deduction within Y and hopefully also avoid withholding taxes on the payment out to X. So X and Y enter into a contract for services. X and Y know that there are no services, in fact, that X is going to perform. They just want to have an agreement which provides a basis for a payment which will not appear unusual to the local tax authorities in country B. So they just create this agreement. There's a nice list of services that will be provided, but they know up front that in fact they have no intention of, in fact, having X provide any services. There's no services that Y needs. It's just a mechanism for extracting money from Y and to reduce country B tax. Now, that is something that I would call a sham or a fake transaction. We have an agreement which looks nice on its face, but the two parties are not. The two parties do not respect the terms of it, and pretty much all countries would disallow and recharacterize this kind of transaction to the extent that they become aware of it. Another obvious one is the case of real estate purchases. If there's some sort of tax on the gain when real estate is sold, then in a lot of countries there can be payments under the table. Now again, you've got an agreement. It says that land will be transferred at 100 and does not mention the 50 that's coming under the table. You've got a sham situation. The parties are not respecting their own agreement. The reason I'm looking at this is providing you a framework to be looking at things. Now, we're then going to get into legitimate transactions as opposed to shams. But the first of this discussion in trying to develop a framework is when you're looking at a particular business situation, are there any agreements or relationships or whatever it happens to be where there are legal rights and responsibilities set out that the parties have no intention of performing? So now we go to, as I say, legally enforceable arrangements. One or more enforceable contracts or legal actions fully respected by the parties, but the real economics and or legal results differ from the form. And notice, although it's a little hard to read, there's three types. And the first one, single contract or legal action. second one multi-step, and then multi-step that's circular with no economic effect. Now, my thought in trying to divide this up this way, again, is to develop a framework for how you can think about these situations, how you can analyze them and eventually come to some conclusions how to advise operating people on this. First, looking at the single contractor legal action, the principal point is that the legal form in the document differs from what is normally used to achieve the economic results intended. And we'll talk about a few examples of that shortly. And the second thing, which is pretty interesting about this, again, nothing is normally illegal about this. Parties are free to contract as they like and to use whatever contractual form they want as long as they're comfortable with the consequences to themselves. And I'm speaking not just, gee, what are the tax consequences, but what legally happens to themselves as a result of the contract. Now, let's first take this issue of lease agreement, because I think this is a particularly good one to use as an example. And also, you'll find that there are a lot of situations where let's say a lease rather than a sale, or a sale rather than a lease is used in real life. And this happens so commonly that a lot of countries will have specific rules on how to decide what's a lease and what's a sale. Has anybody ever looked at the U.S. rules on this? There's a few revenue rulings and revenue procedures. Now again, there may have been updates of this in the past 20 years or so, but there's been ruling policy going back many, many years on how to tell the difference. And the rules the U.S. uses are not necessarily the same that other countries have defined for themselves. And I think you heard me mention in a previous session about the leveraged leasing industry. And again, part of it has grown up from the fact that countries define lease and sale or purchase agreement in different manners. So that one country defines the same transaction one way, another country defines it another way, and that ends up being a nice situation for a structured transaction that's going to be done. Now, the point of this area of single contractor legal action, there's a real transaction that's being done. We're not talking about anything that's fake. We're not talking about a transaction where nothing occurs. X and Y really want to do something, and I'm assuming in this case that they are unrelated. X really does own some asset. Y really wants to use the asset, and they have a choice of how to structure that kind of transaction. Now, of course, if Y only wants to use the asset for a short term, then maybe we, of course, don't have a possibility of showing it as a, well, actually, I shouldn't say that. I shouldn't say that. Part of the current controversy regarding financial shenanigans of major financial institutions today is trying to get things off the balance sheet, trying to get assets and liabilities off the balance sheet. And if I sell something to you today, but we have a separate agreement, which maybe I don't show to the auditors, that says that I will buy it back from you at a certain price, which is maybe the selling price plus an interest element, and this obligation to rebuy will be triggered in 6 months. Yeah, we do have that kind of thing where it's a sale for a short term, but that's maybe more the circular kind that is another one. But here I want to talk about situations where there's really a long use of an asset. Let's draw a chart and let's think about the terms of lease and sale. Now, the reason I'm going through this, again, is from the standpoint of this being a good example as to how you can analyze things. Now, obviously, other types of agreements will have different characteristics, but the process of how you analyze these things is going to be pretty much the same. How you attempt to attack this in some logical fashion. Now, does anybody here rent an apartment? Does anybody live in a rented apartment? Eric, okay, you live in a rented apartment. Now, because you have an honest face, does the landlord just collect rent from you and you do not have a lease agreement? No, you don't have an honest face, or no, you don't have a lease agreement?
I have a lease agreement.
You have a lease agreement. Does that imply you do not have an honest face? Not necessarily. Well, I won't ask anybody else for their opinion on this. But anyway, okay, so we have the landlord as at least being concerned enough that you have a written lease. What are some of the terms in that lease agreement?
There's no subletting. Paid by the first of the month.
Okay, so let's see if we can put down a few of these things. Okay, so ability to sublet. And the second thing was that you said payment by the first of the month, but that implies that there's some amount of rental. And what other terms are there?
Obligation to pay utilities, bill on the month.
Okay.
Not to the apartment complex, but rather to third party.
Okay, so let's call that operating expenses. What about repairs? Are repairs included in that or not?
Right. Obligation to repairs are included in the operational expenses.
Well, I'm asking you about your lease. If for example, let's say that there was a problem with the washing machine, assuming that you have a washing machine. Let's say there was a problem with the washing machine and it did not arise as a result of your kicking the machine. But, you came into the apartment and on the second day the washing machine stops working. At whose expense will that repair be?
Yeah, at theirs. I'm obligated to notify them within 10 days of discovering it, at which point.
Okay, so repairs are the obligation of the landlord. Operating expenses are tenant. Ability to sublet, none. Okay, what else? Okay, what about the term of the lease? Is this open-ended forever, or is this
1 year?
1 year. Let's go back to the rental. Economically, how is the rental determined? Is it based on the value, the inherent value of the property in today's market to buy and sell properties, or is it based on a market value of short-term, 1-year rentals? What's it based on?
Yeah, I mean, there's the, within the market altogether, and there's the other factors just within the complex itself relative to the other apartments. And, so, but yeah, I think for the most part the latter.
Okay, so it's the amount of rental is relative to the rental market, and for example, presumably when you were looking for apartments, whether it was online or in the classified ads in the newspaper, you looked and saw a number of things that were available, advertising prices, and you made your decision in that manner as opposed to the capital value of the entire property.
Yes, and even where I found such information had some bearing on the cost. For instance, it said in one advertisement, mentioned that you found the property here and you'll get, I don't know, a half off on your parking expense.
Okay, so that was another factor. I presume also in today's day and age, whether it provides free Wi-Fi and things like that might be an important issue in the economics of getting into a lease. Okay, now these items, let's contrast all of these different items that you've mentioned. Let's throw one more into this. Was there any clause on a renewal of the lease?
Yeah, I think so.
And
well, I think it just goes to month to month.
okay, and what's the price? Is it going to be a renegotiated price, or do you get that rental forever that you've agreed for the first year?
I think it'd be renegotiated.
Okay, so it's renegotiated based on market. Perhaps your lease did not have an option to purchase the property, but if it did, you would think that it would be the fair market value of the property at the date when you decided to get into it. Okay, so let's say ability to sublet, none, ability to renew or purchase would be at fair market value as opposed to some other figure. Let's compare these to what we would find if we were talking about the lease of an aircraft where the airline really wants this as a mechanism for financing the aircraft purchase. The airline really wants the use of that airplane for the full 20-year life, estimated useful life of that airplane. And who would hold the ability to sublet, so to speak, the aircraft? In other words, have somebody else use it. Would it be the lessor or the airline lessee?
The lessee.
Yeah, the lessee would expect that because economically in their mind, they're purchasing this asset and they would want that. So we would typically see that, yes, the lessee would have that ability. Is the term going to be 1 year or maybe something that is approaching at least the economic life of the asset?
The latter.
Yeah, the latter. So the term is going to approach the economic life of the asset. Now, let's go back to renewals and option to purchase. How would those be priced? Would that be priced based on the fair market value of the property at that future date? Whatever purchase price there is going to be in an option to purchase, or whatever future rental there's going to be in an option to renew, that's going to be decided upfront and economically is going to be based on the original value of the property at the time you enter into the lease and an interest element. In terms of our chart here, we would say that the ability to renew and purchase is not going to be at fair market value, but is going to be at a previously agreed amount based on the value at initiation of the lease. Okay, what about the rental itself? Whereas you're looking at the classified ads or on the internet to see what the various rentals are for different units available, here the airline is really thinking about a rental that is economically the value, the purchase price of that plane today plus an interest element over whatever that term is. Now, what about operating expenses? Yeah, that's really, again, the same thing, a lessee thing. But more importantly, what about repairs? Lessee. Right, because the lessee in this kind of thing is really taking the full risk of ownership, the full risk of operating this thing. Does the engine need to be replaced? That's the lessee's problem. Does the thing fall apart early? That's the lessee's problem. If we look at this one agreement, we see how the terms can economically be something that's a short-term operating lease, such as your rental of your apartment, or in the case of leasing a major asset like an airplane, can be economically and under the terms of that lease the equivalent of buying the asset and having full benefits and risks of ownership. Through the same agreement, we can do either thing. So, again, getting back to this issue of anti-avoidance and substance versus form, when does the form govern? When does the substance govern? This kind of analysis can help you answer that question. Now again, for lease versus sale, a lot of countries have specific criteria. How long is the lease term? Is there a fair market value purchase option? Things like that. But for a lot of these kinds of issues, there will not be a local rule which tells you how to characterize it. And you need a method to try to analyze and figure out how strong or weak your case is on the characterization. Notice there's a few other examples here. For example, parent company extending loans to a thinly capitalized subsidiary. Is that real debt or is that equity? Again, you have a contract that says, I have loaned you 100. You are to pay me interest of so much. The parties respect the obligations that are set up. But there's still an issue of, well, is that economically equity? Because, again, from the standpoint of especially the debtor country, the country where of the debtor, the deductibility of interest in comparison to the usual non-deductibility of a dividend, and the ability to send money back home, even though there may be no earnings, this is something that a lot of times you see used. And will that contractual relationship be respected? Moving onward, we've talked about the single contract or single legal situation. The next one is a multi-step arrangement where, of course, there's two or more contracts and each one individually legitimate that accomplishes a real business goal. In other words, you're really planning on doing something. Again, like with the single example with the airplane, there really is a transaction. It's not in any way a make-believe situation. Same thing here. There's a real business goal, and we have chosen our particular, maybe indirect route to accomplish some sort of tax benefit. So here's a few examples. Let's just draw out the first example so that we see visually this kind of thing. Let's say that we have a customer in another country, and that we have X up here, and let's say that X is going to perform, for example, some sort of construction contract for Y. A lot of treaties have permanent establishment rules that say that the performance of construction activities at a work site will not be a permanent establishment if they're only, let's say, less than 6 months, or less than 1 year, or less than 24 months. Different treaties have different periods of time. So let's assume that the transaction actually is going to be, let's say, 1.5 years, or a little under 1.5 years, but the specific treaty that's there only says 6 months. So X says, well, gee, we can give Y some savings if we can save some country B tax. So X has 3 subsidiaries enter into separate contracts with Y. Under those agreements, the work is split up so that each of the 3 subsidiaries is only active in country B at the work site for 5 months. Individually, each one meets the test of the treaty. In total, they of course would not if we were looking at one company and one job site. So again, substance over form. Do we combine them? Do we not? How do we analyze it? Now, we don't have time to go into a detailed example like the other one, but you might, for example, look closely at the work and the functions of each of the 3. Are they really intricately related to each other so that you couldn't have one without the other? In other words, do all 3 have to be there? In which case you maybe have the authorities have a stronger case to put them together. Or could each one be really, as a practical matter, separate? Maybe the first one is only the work on certain aspects of the foundation. Maybe the second one is specifically only for the framing of the building. The third one is only for the air conditioning system. They're identifiably different. Well, that's a strong point for suggesting, well, each one's separate. Y and a subsidiary could have entered into any one of those three separately without the other two. Obviously, another thing that would make it stronger is if that first subsidiary over there that's going to do the foundation work, it's been in the business of doing foundation work for the last 20 years. That makes things a lot stronger. It's not a structure which is being done solely for tax reasons. There's obvious business reasons as to why this subsidiary enters into it. And if the other one has been doing framing work for 20 years, and the other one air conditioning work for 20 years. So again, your factual situation is going to be part of your analysis on this kind of thing to justify the structure that's used. Remember, we've always talked about there being a blank sheet of paper. You could have this situation where there's three companies. You could have it where Y and X enter into one contract and then X subcontracts to its existing companies. You have a lot of different possibilities on how these things are structured, whether you're creatively trying to structure them or whether you're coming in after the fact and trying to defend them for your client. And the strength of the weakness is going to be dependent upon how strong and what your background is on this, what the factual situation is. Obviously, a back-to-back royalty or a loan arrangement is, when I use the word back-to-back, what do I mean, Joey? Is that a term which is known to us?
Back-to-back.
I mean, are you familiar with the Kingston Trio? Anybody ever heard of the Kingston Trio?
I don't want to get too
Are you trying to say something about your relative age? Now, do you remember the song that has back-to-back in it?
No.
Lyrics are back-to-back, belly to belly, I don't give a damn because it don't matter really. Anyway, despite the relevance of that to this course, what does back-to-back mean in this context? Because back-to-back is a term which we use relatively often. If we have X, Y, and Z, let's say that X wants to lend money to Z. Well, if we lend it straight, that's of course a direct transaction. But if instead we lend it first to Y and then Y lends to Z, with respect to Y, that's a back-to-back transaction. It's through Y. And of course, when the country where Z is looks at this, if because of the location of Y in a favorable treaty country, the country where Z is may look at this and say, hey, this is just a back-to-back arrangement. Multiple steps have been used when they could have done something more directly. And by using those multiple steps, a tax advantage was achieved. So the tax authorities where Z is may look at this and say, hey, we don't accept this. Now, how you try to strengthen this, if you're trying to set something up like this, gets to this point of, well, was there business reason as to why it went through Y? Is Y, for example, an operating company in the same business as what Z is in, so that there's some sort of relationship? Or does Y have a history of being the company for group financings? So again, your factual situation is going to determine how strong or weak your position is, but this is an example of what we talk about when we say back-to-back. Again, same thing with royalties. X could license certain intellectual property to Y. Y licenses it to Z. You've got a back-to-back situation. Okay, third one is multiple step circular arrangements with no economic effect. Each step is respected. Each step is a real transaction, a real contract that the parties are respecting and that the courts would respect. The issue is merely characterization for tax purposes. We're not talking about the agreements being shams or fake. The agreements are real. 2 or more contracts that accomplish no business goal, but they achieve some tax benefit. And this is certainly something that you sometimes see being sold by promoters. Maybe, I'm not sure whether it's less these days than more, but before the tax straddle rules came into play, were enacted, before the at-risk rules, before some of the limitations on losses that came in with the, I think the 86 Act, you had an extremely active market in peddling tax shelters. Anyway, in the international context, we certainly see situations where maybe there's a liquidation reincorporation to transfer a loss from a subsidiary to a parent, or to refresh a tax holiday. Okay, what do I mean by that? Let's say that we have a parent and a sub. And let's say the sub is in some country that grants tax incentives. Let's say that S has a tax holiday for 5 years. Now the 5 years are up, and S is going to become fully taxable at the normal tax rates. So what S does is liquidate, go out of existence, transfer the assets either directly or indirectly through the parent to a new subsidiary, NewCo, which is formed, and NewCo carries on the business and attempts to get qualification for the tax incentive for a new extended 5-year period. This kind of thing was rampant in China because incentives were so easily granted for pretty much anybody who could walk and chew gum at the same time and also happen to manufacture, and was at least 25% foreign owned. So you had a lot of this kind of thing going on in China. Now, it's only recently that China has gotten very excited about this kind of thing. So I don't think we're going to be seeing a lot of prior transactions recharacterized, but China's become very cognizant of this kind of thing. Now, you have quite a variety of reactions from various countries. Again, mentioning, as I did before, that if something's sham or fake, pretty much local governments are going to disallow whatever it is. And of course, that makes sense, because if you have a fake transaction, if you have a contract in form, but not a contract which is legally enforceable because the parties really don't intend to act upon it, then you don't have a basis, in a sense, for your transaction, and the authorities are rather free to characterize what's happened in the way that they want to. Where there's legitimate transactions, you really have what I will call a wide variety of reactions. And they can range from just blindly accepting them to looking very serious at substance. And this really is a moving target. And again, China, Indonesia are very good examples of this, that over time they change their tunes. They change what they look at. This is something that really has to be monitored. Also notice this bottom point, that there can be significant differences here between what the tax authorities think and what the local court system will, what they will sustain in the way of actions of the tax authorities, or will not sustain. You have some number of judges around who are not necessarily fans of the tax authorities. And here's a listing of the available tools that tax authorities have that are somehow related to this area of substance versus form, general anti-avoidance. And really all of these things are aspects of that.
Excuse me.
Yes.
Could you discuss the second last bullet point, please? Beneficial owner concept?
Okay, we'll go into more detail later on that, but in brief, your Article 10, 11, and 12 of the Model Convention and of most treaties, they deal with dividends, interest, and royalties. They say that in order to achieve whatever benefit there is under the treaty, the person who is claiming the benefit of the treaty, which means either an exemption or reduction in withholding tax on dividends, interest, and royalties, must be the beneficial owner of the income. The obvious question is, well, what is beneficial owner? Now, we talked last week briefly about the Indo-Food case. And the court in England decided on what was effectively a back-to-back loan situation through the Mauritius company, that the Mauritius company was not the beneficial owner of that income. It was just in a sense, a paper thing in the middle between the investors and the ultimate user of the money, which was the Indonesian company. Now, just to give a little bit of thought about what I'll call common terminology, tax planning or minimization, when people use that kind of term, they're normally thinking that what the taxpayer is doing is consistent with the purpose of the statute. I'm a foreign company. I want to manufacture in your country. Your country has a tax holiday that will allow manufacturers a certain benefit. I structure my activities so that I make sure that I qualify for those benefits. There's consistency between what I'm doing and what the statute, in fact, wants to encourage. This type of language is a very appropriate thing to be doing. And notice again down at the bottom, full disclosure basis. Nobody is trying to hide anything. We hear the term tax avoidance reasonably often. That implies that we're following the law, but we may not be economically doing what the law really was trying to encourage. So, for example, any sort of treaty shopping situation, we're clearly following the law in creating a company which is resident in a treaty country to make a loan, for example, into China, or let's say we set up a Hong Kong company, whether it's going to make a loan and receive interest and receive a lower withholding tax rate, or a royalty with a lower withholding tax rate, or a dividend with a lower withholding tax rate. We're following the rules very clearly. But was that really the reason as to why Hong Kong and China have an arrangement between them to allow any third party in the world to get benefits from China, no matter where you're from, as an ultimate investor? So I think tax avoidance is a term which would be this kind of situation. You're following the law, again, full disclosure basis, but the result may not be something that the drafters of the law necessarily intended. And then tax evasion, we actually have fake or fictitious transactions, and needless to say, there's probably not full disclosure to the authorities of what is being done. And this type of thing generally being potentially a criminal matter. This is kind of interesting. This is taken from the IRS manual and gives their definition of avoidance versus evasion. What do we get out of this discussion of form versus substance and general anti-avoidance rules? Well, I think the first one is that we really need to develop a sensitivity to situations where this is something you have to think about. In other words, you see a factual situation, you see the contracts that are being entered into, you see the tax results that your client or the company you're working for has gotten itself into in the past. And you need to have that sense that, well, we should analyze this if it hasn't been done already. And even if it has been analyzed already as to how much risk there is, we need to maybe update our analysis, because we know how quickly countries can change their tune on this spectrum of how much respect they give to form versus substance and how they attack these things. So I think developing the ability to recognize it is probably the most important thing. Obviously, communicating it to a decision maker, documenting what it is in writing, and of course working with clients to minimize the risk by trying to make as clear as possible the business reasons for situations where you see this risk, and documenting those things. Again, the goal has been to give you a framework so that you can you're better able to analyze these things. We want to talk about transfer pricing a bit. Now, I'm assuming, perhaps incorrectly, but I'm assuming that you've done some amount of discussion of transfer pricing, presumably in one of your 2 international tax courses. What I'd like to do, I'll go relatively quickly through a few slides, and then we will talk a bit about the drug company case that you had as a handout. Not so much specifically what's in it, but rather what's behind it, and use that from a transfer pricing perspective to try to understand conceptually how one needs to be thinking in terms of planning with transfer pricing and values in mind. You have both in the overview and in your section 482, which you of course have the regulations, voluminous regulations. You also have a copy on the website, the course website, which of course you have access to through the library, through source OECD of the OECD transfer pricing guidelines, which were reissued in 2009, and which, again, I would recommend familiarizing yourself with, not so much trying to read the thing in detail, but rather look through and see generally what's there. Transfer pricing is an important part of what I will call that sanctity of the separate legal entity. We have X and Y. If they have transactions between each other, those transactions have to have a value. Now, of course, if we're bartering something and we only have one asset going one way and another asset going the other way, which is not cash, well, we don't have, in a sense, a valuation in dollar terms necessarily within the contract. But that's not the usual way that most businesses conduct their activities. There's pricing. There's cash going one way and assets or services or intellectual property or something going in the other way. So when two companies are dealing, they will, just by their very nature, have to value the asset or the license fee or the interest element or whatever it is between them. Now, when two companies are dealing at arm's length because, in fact, X and Y are unrelated, then, of course, that happens rather naturally. Taking that example before where Jasmine was going to pay me to give her this thing, but it's really a bribe, she's not going to pay me because we're unrelated any more than she needs to. So, and I'm not going to accept any less than what I'm going to accept. So we end up with a real economic bargain. We're unrelated parties. But if X and Y happen to have a common owner, which is W, all of a sudden, because we're related, because X and Y are related, we can enter into that transaction at whatever price we want, and W will not care. Economically, W's in the same place. So, in a fully controlled situation, pricing does not matter to the participants economically. Now, I say that it doesn't matter to the participants. In terms of W, it does not matter. But you may find various parties within this kind of thing who do care. For example, maybe Y has is in a certain business, and of course it has management of that business, and some of the managers, their bonus is based on the results of Y, and have nothing to do with how much the earnings of X or W are. So even though you look at something like this and you say, well, gee, it doesn't matter what price is paid between them for the purchase of an asset, license of property, or intellectual property, or whatever. Even though from W's perspective it does not matter, there might be parties to whom it does matter. And that's important to recognize, because if you do have managements of Y and X who in fact are acting like unrelated parties, that may help you in terms of supporting the pricing between them. In any case, it's part of the background of your analysis of this kind of situation. A number of countries have, let's say, ownership rules on their transfer pricing which are not the same as what we have in the United States. We have this sort of religious 482 concept of over 50%. It's control being over 50%. Well, China uses a 25% figure, 25% or more. Vietnam, a 20% figure. You cannot assume that just because you are under 50%, just because you have a minority interest, you might still have transfer pricing concerns under the rules of some countries. And a lot of countries do have provisions for other forms of control. Common directors or management, the influence of a major vendor or creditor. You can see these kinds of things sometimes in the transfer pricing rules of a particular country. Transfer pricing is important not only for taxation reasons. So when you see transfer pricing, again, like I mentioned, the management of X and Y may be very concerned about it because their compensation is based on a pool which is not the whole. So just listing out a number of reasons why transfer pricing can be important. The first one, the ability to pay a dividend in most countries is based on there being retained earnings under whatever statutory accounting rules there are. Unless you have a profit and retained earnings, you can't pay a dividend legally. And transfer pricing affects that. If you're, if well, let's just say that whatever the level of the transfer pricing is, that will increase or decrease each company's bottom line. So that's one item. Okay, second one, management P&L results as the base for employee incentive compensation. Companies, even though they're maybe 100% owned, subsidiaries will often have separate company financial statements because there are, in fact, local shareholders, or maybe there's, minority shareholders, or maybe there's creditors locally that need financial statements. Maybe you have financing locally from banks for the local operations. In your assignment 4, you're talking about a subsidiary that's going to have this major operation to manufacture neutral power products. One possibility is that it could borrow locally from banks. Well, you probably need a set of financial statements for that to give to the local creditors. Tax expense within the consolidated financial statements. Remember that when we talked about the consolidated financial accounts of the company, it would show tax expense for the group of companies. In other words, if you're talking about the financial statements of the parent on a consolidated basis of the group, the tax expense of the subsidiaries is going to be part of that consolidated result. And transfer pricing obviously affects taxation, and especially if there's excess foreign tax credits, you're not getting a full benefit from foreign tax credits, the transfer pricing can affect how much tax is paid and ultimately the financial results of the company. Transfer pricing for goods that are imported can affect import duties, value-added tax, and any excise taxes applicable to the product. If you are increasing the transfer price to try to get money out of the country, well, maybe that's increasing import duties, which you don't get a tax credit for, because that's not a tax on income normally from the standpoint of the home country's foreign tax credit rules. Now, transfer pricing has really become an extremely major area of risk. It's probably the most important area of risk faced by many large groups of companies today. And the points, I think, are just very simple. Number one, when you realize that transfer pricing adjustments normally affect, for example, the revenue line in a company, or the cost of goods sold line in a company. In other words, so it's up at the top part as opposed to after expenses and down to the bottom. So let's say if you have 1,000 of revenue, and maybe you have a company that after all its costs and expenses, you have a net income of 100. And then on that 100, let's say at the 25% rate of tax of 25, you could easily have a pricing adjustment which might change the 1,000 revenue up to 1,500, where the adjustment is 500, let's say. And from a percentage standpoint, you've just increased taxable income from 100 to 600. The tax has now gone from 25 to 150. And the numbers are just potentially astronomical. A lot of companies work on very low margins, so that revenue numbers are very, very high in comparison to net income. So a small adjustment at the revenue line or the cost of goods sold line can be just astronomical at the level of the net income and the actual tax liability. So that's one aspect, literally astronomical numbers. Secondly, the area of transfer pricing, although a lot of consulting firms are out there, selling scientific approaches, so to speak, to determining transfer pricing, it's a very subjective area. It's not an exact science. And two people can very much disagree on the weight of various factors to determine what a reasonable range is. There's certainly a reasonable number of court cases out there showing how there can be very, very significant amounts at issue over the subjective interpretation of these rules as applied to particular fact patterns. So very subjective. And then lastly, this is becoming more and more and more a worldwide area of interest. When I first went overseas, literally the only country that was halfway serious about transfer pricing was the United States. Generally in other countries, you just didn't care. But nowadays, it's become more and more a major thing, with countries all over the world being interested in it. I suppose another point that I should have put up there, think about it this way. You've got X in one country, Y in another country. The tax authorities in X say, gee, you didn't put enough profit in here, we want to make a transfer pricing adjustment, increase the profit in X. Do you think the tax authorities in the country where Y is are going to say, yeah, you're right, you paid too much tax in country Y, I'm sorry, in the country where you paid too much, Y paid too much tax, we'll give you a refund because the country tax authorities where X is are making this transfer pricing adjustment. Do you think there's voluntary refunds whenever there's a transfer pricing adjustment by one? Yeah, there's not. Now, where there's a tax treaty, yeah, there's a mechanism to do something about it. But a lot of these situations are not tax treaty situations, simply because there's not tax treaties between the countries involved. And further, the whole process of going through the tax treaty competent authority process is long, involved, and miserable. Areas of reducing risk, okay. Seeing that your client actually has transfer pricing policies that are consistently applied, very important area. And secondly, that there is documentation of that policy and how it's been implemented. And this third thing, advanced pricing agreements, more and more large companies, in order to reduce the risk, are actually entering into either unilateral or bilateral agreements with various countries to get agreement that for the next 3 years, all parties will agree that this is the methodology that will be used. And this, although obviously administratively a process to go through, and it's not necessarily cheap, but it reduces risk having this kind of agreement up front, and is becoming more and more popular. We'll talk a little for a few minutes about this drug company situation. You've read this article. And what did it say that the drug companies were doing? The article said that 6 U.S. drug companies had approximately $75 billion of retained earnings sitting in overseas subsidiaries, and that the bulk of that $75 billion was either untaxed or taxed very low, at very low rates by the countries where the money was. And the article itself, because it spoke only to people, the reporter only spoke to people who were critical of the drug industry, of course it comes across as a relatively negative article that the drug companies must be doing something wrong. Yet, interestingly enough, the drug companies were a major user as a result of this situation, of this sort of amnesty, not really an amnesty, but an encouragement that Congress made in, I think, 2003, 2004, in that period, to encourage U.S. parent companies to have their subsidiaries pay dividends, repatriate earnings to the U.S. in order to create jobs. Drug industry, the pharmaceutical industry, clearly made very, very good use of this. So the obvious question is, if they made such good use of this, they had all this $75 billion of earnings overseas, they must have done something right with regard to their international tax planning. The discussion here for a few minutes is, well, maybe what did they do? And because we're talking about transfer pricing, and because we're not talking about the mechanics of transfer pricing, we're not talking about the comparable and controlled pricing mechanism, we're not talking about the resale method or the cost plus method. Rather, what we want to think about is, in a larger sense, how does one use values that happen to be there in the context of a particular factual situation? How did the drug companies, what is one possible way they use these values and the assumption of risk in certain companies, certain legal entities? And again, remember, sanctity of the legal entity. This is important. It creates real advantages which our U.S. tax system, which has been in business for 100 years, give or take a bit, and has all sorts of things in it, all sorts of tools and mechanisms to beat down anybody who wants to inappropriately save tax. How did these companies accomplish this wonderful goal of having $75 billion among the six of them? So that's what we want to try to look at and ask the question of, how did they take a blank sheet of paper and manufacture a situation that created this? First, let's ask the question, what are some of the activities and risks inherent in the pharmaceutical business? What are some of the activities and risks inherent in this business?
Research and development.
Okay, good point. R&D. And where do you think that most U.S. companies have traditionally performed the bulk of their R&D? In the States. Yeah. So, again, let's, for simplicity in our discussion, assume that this R&D is conducted in the U.S. What other activities are there?
Manufacturing.
Okay, manufacturing. Okay, so maybe manufacturing encompasses a couple of things. Maybe there's, once you have the R&D done, you've created a formulation for a drug. You next have to create the substance, put it into pill form or capsule form or whatever the appropriate form that it's going to be ultimately sold in. Where might that be done?
Overseas, cheaper.
Well, you could, yeah, you could do it overseas. Maybe if there's a lot of labor component to it, then maybe it could be cheaper in some places overseas. I suspect that a lot of that is probably done by machines, so labor component might be a little bit lower. But still, you're absolutely right. Overseas, in certain locations, may have lower labor costs. The point I want to make here is that, is it pretty much open as to where they decide to put a building and machinery for this kind of thing? In other words, let's assume that the raw materials are generally available pretty much anywhere in the world. Because there's a worldwide market for these things, maybe from a delivery standpoint, it doesn't make a heck of a lot of difference. There's certainly some difference, but a heck of a lot of difference from a transportation cost perspective. whether we ship them from somewhere near St. Louis or whether we ship them from someplace near, in Southeast Asia or in or from Ireland or something like that. The point is that there's a lot of freedom to choose, well, gee, where are we going to do this manufacturing? We have a lot of choice. Now, there may be some places we specifically don't want to go, but generally we have flexibility on where to put that. Now, notice I'm not putting boxes yet in this. We will choose some location outside the U.S. where there will be some activity, which is the manufacturing activity. What other activity is there?
Well, there's going to be a lot of patents or patenting of these different drug inventions.
Okay, that's good. Now you're
Well, I don't know if that's an
going
activity,
from you're going from activity to product. No, to asset.
That's right.
And that is great. We'll get back to that in a moment.
Sales?
Sales, yeah. So there will be both inside the U.S. and outside the U.S. sales efforts. Now, just to make things more specific, let's assume, or actually let me step back and ask a question. Do you think the price of a particular drug item is exactly the same no matter where you are in the world? Now, Summer, I see your head going like this. I can't imagine that there'd be different pricing. Why do you say that there would be? There would be.
I mean, there is different pricing, but
Have you never received an email from a Canadian drug seller?
no, I don't receive a snapshot.
You don't receive junk mail?
I do.
Yeah.
I don't respond to it. That's what I meant to say.
Oh, okay.
Yeah.
Well, that's encouraging. Okay, so the point is that there really are markets around the world where the pricing is different. Sometimes for drugs, there's government mandates. Sometimes for some countries, they want to be able to have the product used by a broader section of the population, so they have lower prices. But generally, if you look at your very developed countries, the U.S. especially, maybe Germany and some of the other European countries, the prices are going to be relatively higher. Let's assume, for simplicity, that this sales force is in a country which happens to be a high-tax country. Okay, so we've got activities so far, R&D, manufacturing, and sales. I think that's good for the sake of illustration at this point. There's obviously also going to be various administrative activities and other support functions and so on, but let's stick with these three. Now let's talk about assets, since you brought assets up next. You mentioned the intellectual property, the patents, maybe also how you formulate the product, and so on. So that's clearly going to be one. So let's list the assets down here where we have some room. So let's say the IP. What other assets are there?
Manufacturing facilities.
Yeah, manufacturing facilities and equipment. Okay, so facilities and equipment. Anything else? The salespeople will presumably have offices and computers, so some sort of office equipment there. The R&D people will also have some sort of facilities. Okay, I think for the moment that's, again, sufficient for purposes of illustration. What about risk? What risk do we have here? Okay, one is lawsuits. I certainly agree.
Not getting FDA approval.
Okay, not getting FDA approval, which means the R&D goes down the drain, perhaps. Yes, Eric? Okay. Even going a step back from the approval of the FDA is going to be, is our R&D just throwing money down a rat hole because we don't produce anything. We don't find that cure for cancer that we're trying to search for, or whatever the issue is, whatever the disease or problem is. So there's clearly a tremendous amount of risk with regard to whether the money spent on R&D will in fact create an asset or just be money drained away. What about risk with regard to sales? Now that's going to depend maybe on what the nature of the product is we're trying to sell. So whether there's high risk or low risk. If you were the Boeing aircraft company in the 1950s looking at whether there would be a market for a 707, that was a rather high-risk thing. Are we going to be able to sell this thing? And that uncertainty was part of the decision to either go ahead or not go ahead with developing the airplane. Let's assume, again, for purposes of simplicity in what we're doing here, that the R&D has in fact created a very, very, very wonderful cure for something, and as a result, by God, we know the market's there. So that the risk on sales is not so much. Okay, let me go back one step and go back to the intellectual property. Here we're focusing on the patents and product formulation and so on. But what about the marketing intangibles within the sales force in our high-tax country? Does that have, relative to the value of the intellectual property, the patents, the product formulation, are the marketing intangibles about the same value? Are they higher? Or are they likely to be lower considering what we have given as a situation here? In other words, that in fact this company through its R&D effort has created a really wonderful cure for some very problematic disease. Will the marketing intangibles be worth little, about the same, or more than those patents and product formulation? Is this going to be easy to sell?
Yes.
And what would happen if, God forbid, the building where the sales people were located burned down and all of them were inside? Could we find another group of salespeople for a type of drug? Or would that really be hard to find more salesmen who know something about the distribution chain for pharmaceuticals in that country? Are salesmen going to be a dime a dozen, so to speak? Or is it really going to be hard to find them? What do you think? Probably it would be easy. Now, of course, there might be factual situations where finding the right salespeople could be very difficult, and as a result, the marketing intangibles might be very valuable. But in the situation which I've described, those marketing intangibles are relatively low value, especially relative to the high value of the intangibles that the R&D has created. Okay, so we have this issue, or this, let's say, summary of activities, of assets, and risk. We said that there was high risk in connection with the R&D, low risk in connection with the sales, and that the IP itself is of very high value. We have not put any boxes around anything yet. We've only talked about activities, assets, and risk. You keep hearing me say, we have a blank sheet of paper. We can put boxes where we want. We can have whatever entity we want to conduct activities. We can have whatever entity we want own property. We can have whatever entity we want bear risk. And when you bear risk, generally that also means that you accept the benefit of gains if that risk happens to be managed properly and whatever you've created goes up in value. To make a relatively long story a little shorter, we could, of course, have our pharmaceutical company, X up here. We could have X do all of these activities. And we're saying this is the United States. And if we chose to have X do all of these activities itself, then 100% of the income from this would be taxed in the United States. Currently, if the manufacturing happened to be in another country, then some amount of income from the manufacturing activity will be taxable in that country. Some amount of the income related to the sales activities will be taxable in that high tax country. And at least for U.S. purposes, there's no deferral. We have worldwide taxation, foreign tax credit for taxes paid in the other locations. That's what it is. Again, just like our initial example we gave back in session 1 of this class. But now, let's draw a couple of boxes. Let's just draw a box over here around the manufacturing, 100% owned. And let's also, although this is not the only way we could do it, but let's also, again, to make a long story short, as opposed to going through a lot of different examples, let's draw a box around the sales activities so that there's a sales subsidiary in that high tax country. It's rather obvious that we put the manufacturing down in this country, and let's assume that this is a country with a tax holiday. It's rather obvious that our salesmen and sales activities are over in the sales company. The company down here will, of course, also employ workers doing the manufacturing. The R&D is being done in the U.S., so we'll assume that those are employees of X. Okay, we've apportioned out activities, but we have not yet apportioned out assets, or certain of the assets, the intellectual property, and we have not apportioned out risk. We have a blank sheet of paper. If we know that the pharmaceutical companies ended up with $75 billion in low-tax overseas earnings, what must they have done? They must have somehow put the risk of conducting the R&D, which is ultimately what turned out to be wonderfully valuable because they apparently did a good job on their R&D. They put the ownership of the IP and the risk in the risk of doing the R&D, hoping there would be IP to own, they put that in the company down here, which ultimately became the manufacturing company. Now, they might have put it in another company somewhere else and then licensed it to the manufacturing company, but just for simplicity, let's just say that they put it into the company which is manufacturing. Now, how do you put risk and ownership of resulting IP into that company? How do you do that? Do you do it by just saying, gee, I'll do it? Or do you have to construct, under this concept of every entity as a separate legal entity and they can contract with each other? And as long as it's on arm's length purposes, on an arm's length basis, then generally countries are going to respect that. So how do you put the risk and the ultimate ownership of the assets, the IP which is created from that R&D, how do you put that down there in the manufacturing company? What contracts, what relationships between the companies are necessary to achieve this? X and the manufacturer could enter into an agreement, okay, not a lease agreement, but rather a service agreement, where the manufacturer says, I want to bear the cost of whatever R&D is done. I want to be the one who is at risk, totally at risk. I will pay a service fee, for example, on a cost-plus basis, to X for the R&D activities that X's employees are going to perform. X is at no risk other than credit risk of not being paid for the services it's providing. X will get paid its cost-plus amount whether the R&D yields actual patents and other intellectual property, or whether it's just a total wipeout. On a separate company basis, X is not taking any risk with respect to whether the R&D will succeed or fail. The manufacturer is taking it. Now, of course, if the manufacturer and X are entering into this kind of a contract, this manufacturer is going to have enough money from either invested capital from X or its own earnings from other activities it performs, or from its ability to borrow, either from related or unrelated parties. So the manufacturer, separate legal entity, it can choose to enter into a contract which puts itself at risk, because again, separate company basis. Even though X ultimately, in an indirect economic sense, is the one taking the risk, but our legal and tax system respects this. Nobody is calling this a sham. It has legal reality, and the activities, assets, and risk are consistent with the pricing mechanisms between them. Now, the manufacturer, let's say now, because it has accepted the risk, it has paid a cost-plus amount, it is the owner of the IP, it now has the value of that IP created from the R&D which it spent. And again, the manufacturer was at risk. It could have gone bankrupt if the R&D was not successful in creating something of value. This creates legal reality on a separate company basis that our tax law and general legal principles respect. We can draw this out, and we make it consistent, and we put the values where they need to be. Now, over here, from a sales standpoint, remember we said that the ability to find salesmen is not too difficult. So if we said in this particular factual situation, where is the bulk of the value? It's going to be down here where there has been successfully created IP as a result of that manufacturing company taking the risk and being lucky that they actually found something. It could have gone the other way. Again, there has to be consistency between who really bears risk and what they own and the benefits they achieve. Now, once you have all of the assets, all of the IP down here, and you've paid an adequate arm's length service fee for just the services of R&D, you don't need to pay X anymore. The ownership's down here, and now this one can earn a relatively high amount from the ultimate sale into this country. When the sales company sells to the third party, they're going to get real arm's length selling prices, of course. So the question becomes, what sort of transfer price do you have between the manufacturer and the sales company? Now again, not getting into the mechanics, but if you try to develop an arm's length price, probably using the resale method, you would end up with a relatively minor amount of income here, and again, the bulk of it down here. Again, the goal here of this example is trying to get across not the mechanics of transfer pricing, but what is behind transfer pricing, both in reality and from a planning point of view. You've got to look at those three things: activities, assets, and risk. And to some extent, each of those three, or at least some aspects of those three, will be variable with respect to where you put them, who owns them or who incurs them. And you can use your imagination in trying to come up with something that works for your client's situation. Thank you, and good night.
Thank you.